Hi everyone, welcome to my channel. My name is Rishi, and today we're going to talk about WACC, weighted average cost of capital. So, what is WACC? WACC represents the average return a company needs to earn to satisfy everyone who has invested money in it. So, companies usually raise money in two ways, either by borrowing or by issuing shares. Borrowing money has interest, and shareholders expect a return for taking risk. WACC blends these different costs together based on how much of each the company uses. So you can think of WACC as a hurdle rate. If a project earns more than the WACC, it adds value. If it earns less, it reduces value. So if you look at the equation for WACC, okay, it's simply debt divided by debt plus equity multiplied with the cost of debt multiplied with 1 minus tax plus equity divided by debt plus equity multiplied with cost of equity. Okay, so for example, let's assume debt is 400 million, equity is 600 million, cost of debt is, let's say, 6%, the tax rate is, let's say, 20%, cost of equity is, let's say, 10%. Okay, cost of equity is usually greater than the cost of debt because equity holders have a residual claim on a company's assets. So to calculate WACC, this is what we will do. WACC is equal to 400 million divided by 1,000 million or 1 billion multiplied with 6%, 1 minus 0.2. Why do we subtract tax? Because interest is tax deductible. When we prepare our income statement, if a company has borrowings, it can use the interest that it paid to reduce its taxes. Okay, then we will add 600 million divided by 1,000 million multiplied with 10%. Okay, so that's, let me just quickly calculate that. That's 6 into 0.8 into 0.4. That's 1.92% plus 0.6 into 10%, that's 6%. Okay, so the answer comes out to be 7.92%. So that is a basic illustration of what WACC means. Again, it is the average return a company needs to earn to satisfy everyone who has invested money in it. Companies raise money by either borrowing, which has interest cost, or by issuing shares, in which shareholders expect a return for taking risk. So think of it as a circle. Like if you draw a circle, let's say this is debt, this is equity. We got to find the proportion of debt as the total value, right? So if I value can be defined as debt plus equity here. So what is the proportion of debt as a proportion of total value? What is the proportion of equity as a total value? Multiply with the respective cost, and that is WACC. How do we find this cost of equity? We would be using something called CAPM, which I'll be explaining in my future lessons. So please subscribe to my channel to watch more videos on corporate finance. And hopefully you like this video, and I'll see you in the next one. Thank you.